Hello, good evening. How are you? I hope you guys are doing well. Okay, I welcome you all to the first class of the crash course of the financial reporting. I am your instructor and I will be taking you along this journey of a quick revision for the whole FR over here. And primarily, our focus is going to be the practice of the exam kit. Meanwhile, if you guys have any particular topic in mind that you want to revise or something, you guys can let me know so that when we are doing the questions of those particular topics, I can re-revise that particular topic from the theoretical point of view as well, right? So the approach, you guys are already familiar, maybe. Right? I will just repeat it up over here that you have the recorded lectures as well. So from every live session, there is a prerequisite to watch a recorded session first, where theoretically, the accounting standards or the topics are going to be covered. And then over here, in the live session, we are going to do the comprehensive practice of the Kaplan exam kit. And whereas the discussion is concerned, in the pre-recorded sessions, the recorded videos that you have, what we do over there is we have the practice of the BPP exam kit over there. And then in the live session one-to-one, we are going to cover up the Kaplan session over here, right? So let's start without wasting any time. I hope you guys have gone through as far as the videos are concerned. So here we go. And this is the first session that we are going to do over here. So starting with the question number one, IAS 16 property, plant and equipment requires an asset to be measured at cost on its original recognition in the financial statement. That is the first time initial measurement. Yes, it has to be on the cost. Now, EW used its own staff assisted by the contractors when required to construct a new warehouse for its own use. So EW, a company, used its own construction staff to construct the warehouse, right? So identify whether the cost listed below should be capitalized or expensed. So the clearance of the site prior to the commencement of the construction is concerned. Yes, preparing the as far as the site for the sake of the construction is concerned, that is something, the cost for that is capitalized. Professional survey fees for managing the construction work. Yes, this is something which is capitalized as well. EW's own staff wages for the time spent working on the construction. Yes, this is capitalized as well. A proportion of the EW's administration cost based on the time spent. No, this administration cost is something that would have had occurred no matter if the construction was being done or not, even on this project or not. That cost is something that would have occurred in any case. So that is going to be irrelevant over here. So that is something which we are going to expense out over here, right? And the typical reason for this, which I have told you already, that the administration cost is not going to be included, as these are not directly incurred as a result of carrying out the construction work is concerned. So that is why it's not going to be capitalized over here. Then we have the point two over here. On 1st July 2024, experimenter opened a chemical processing plant. The plant was due to be active for 5 years until 30th June 20X9, when it would be decommissioned. At 1st July 2024, the cost of decommissioning the plant were estimated to be 4 million in 5 years' time. So in 5 years' time, when you are going to decommission the plant, you will have to incur the 4 million. Now, the experimenter considers that a discount rate of 12% is appropriate for the calculation of a present value, and the discount factor at the 12% for the 5 years is 0.567. So what is the total charge to the statement of profit and loss in respect of the decommissioning for the year ended 30th June 20x5? So it's asking about the total charge in profit and loss. Now, as far as the total charge is concerned, technically speaking, when the decommissioning cost will be capitalized, we will do the following double entry over here. And that's going to be, we are going to debit the asset and we are going to credit the future decontaminating cost credited over here. Now, the cost is total 4 million multiplied by 0.567. So 4 million multiplied by 0.567 gives us 2268000 over here, right? So we are going to debit 2268123 and 2268123 over here, right? So this is one thing. So on the asset half, this is the 5 years time, right? So we are going to, cost number one is the depreciation of asset half in the income statement, and that is going to be 2268123 by 5. We get 453,600 over here. Number two is the unwinding of discount over here as well, because we have to unwind this cost, and that is going to be 2268000 into 12% for the year. So that's going to be 2268123 into 0.12. So that's going to be 272,160. So the total is going to be 725,760 here. So this total 725,760 is something that we are going to charge into as far as the income statement is concerned. The reason being, this is related to as far as the unwinding of discount is concerned, that we have to take into account as far as into our local income statement is concerned, right? Then we have a third point over here, and that is an entity purchased property for 6 million on 1st July 2023. The land element of the purchase was 1 million. Expected life of the building was 50 years and its residual value nil. On 30th June 2025, the property was revalued to 7 million, of which the land element was 1.24 million and the building was 5.76 million. Then on 30th June 2027, the property was sold for 6.8 million. Now, what is the gain on the disposal of the property? That would be reported in the statement of profit and loss for the year to 30th June 2027. So we have to talk about the gain that we have to take into account as far as the gain on the disposal is concerned. Now, over here, this is a three-step kind of approach question over here. First, we had the cost. Then the building was depreciated for a certain time period. Then it was revalued. And after revaluing, it was then sold later after a number of years as well, right? So we have to, go with the flow, and we have to take into account, overall speaking, as far as, everything related to it, which was done over there, right? So, how we are supposed to do, I mean, you can go for the disposal account as well, right? I mean, we can straight away create a disposal account over here, right? So this is going to be my disposal account. If I take it up over here, this is going to be the assets cost. So this is the total value of the property is 6 million. I have to have the accumulated depreciation over here. The cash proceeds are over here. Right. All right. So let's see. And the revaluation is supposed to be over here, which we need to take into account over here as well. But, we have the revaluation, but the thing is, we have to calculate the total gain that we have to take into as far as the income statement is concerned over here, right? So, let's see now. We have the revaluation on 30th June. Okay, so 30th June 2025. So technically X4, X5, 2 years gone by. Fair value of Wait a second. Rather than going like this, I can do one more thing. Look, we have land, we have building, we have total, right? Let's just go into the millions. Let me show you. Cost 1st July. Land is 1 million, building is 5 million, total is 6 million, right? Now I am going to have the depreciation building 2 years. That's gonna be 5 million by 50 years into 2. So that's going to be 5 by 50 into 2. So that's going to be 0.20. So we will minus this 0.2 from here. So we are going to get the carrying value at 30th. This is going to be 30th June 20x5. Okay. Now, so we are going to have a value of 1 here, 4.8 here, 5.8 over here. Now, the fair values are given to us. And the fair values are 7 million, land element is 1.24, and the building element is 5.76. So the total is 7. So we have revaluation gain over here, and that's gonna be this minus this minus this, and this minus this, right? All right, now we are again going to have this is the 30th June 20x5. Now on 30th June 20x7 I have sold now. So I have 2 more years, so I will have the depreciation charge for 2 more years, and that's going to be 5.76 divided by remaining useful life, that is 48 years, because 2 years are gone, and then I have to take up for the 2 years again, so 2 years over here. So I will have 5.76 by 48 into 2. I get 0.24 over here, nothing over here. So I will have my carrying value at 30th June 20x7. Here we go. So we will have now the values 1.24 and so on. So I have the value of 6.76 over here, right? And now it has been sold for 6.8. So this is the carrying value, and this is the disposal proceeds for 6.80, right? So I am going to have my gain on disposal of 6.8 minus 6.76 is 0.04. So 0.04 multiplied by 1 million is going to be 40,000. So I have a gain of 40,000 over here, right? In the statement form, if I try to do this, this is how you are going to have it over here, right? So that's how you are supposed to have it over here. Done? All right. Now, moving ahead from here, question number 4. A manufacturing entity receives a grant of 1 million towards the purchase of a machine on 1st January. The grant will be repayable if the entity sells the asset within 4 years, which it does not intend to do so. Now, the asset has a useful life of 5 years. The useful life is 5 years. We got the grant on 1st January. The grant is of 1 million. The year end is 30th June. So technically from 1st January till 30th June, only 6 months have gone by, right? So we have to talk about the deferred income liability that we have to take into account. So total value of grant is 1 million. Total life for grant is, I mean, the vesting conditions are for the 5 years. No? For 5 years, we have to keep the asset with us, right? So technically speaking, income recognized is going to be 1 million by 5 into 6 by 12. That's going to be 100. So 1000 minus 100 is 900, because this is in thousands now. So 900,000 is going to be my answer over here, right? All right. I hope it's clear. Now, this is the deferred income liability it was asking from me, okay? This was the deferred income liability that it was asking from me. So that is why I am going to have this 900,000 over here. Then, if it would have asked me that what amount of the income is going to be recognized, then the answer would have been 100,000 over here, right? Out of the 1 million for 6 months, 100,000 has been accounted for. So that's going to be shown as an income or the grant income over there in the income statement. And then the remaining amount is going to be shown over here at 900,000. Okay. Okay, before I move forward, I just want to mention, although everything is running smooth and all, actually, I updated my system due to which I don't know, maybe most probably, yeah, I don't know. Yeah, I mean, I know it's a software glitch yet, because in the updated version there are some bugs and there are some issues because of which my MacBook, out of the blue, it just restarts. I mean, I updated it onto the latest OS, but maybe because of the bugs or something, my MacBook, like, it just simply hangs and it automatically restarts. Okay. So if by any chance, I get disconnects or something, or the meeting gets disconnect or something, don't worry. Straight away join it back again, and within like around 2 or 3 minutes, I will be back online. Okay. I mean, I updated it yesterday, or yesterday I just had this issue for once only, but today I've been using it from, like, since morning, and it's working stable and fine. But it's just that I wanted to tell you guys, so that is why, like, I'm just intimating you in advance, that say in case if meeting gets disconnected or something, don't panic or don't worry. I'll be back in around maximum 2 3 minutes. Okay. So we were talking about the next question now, question number 5. On 1st January 2021, state received 1 million from the local government on the condition that they employ at least 100 staff each year for the next 4 years. Due to an economic downturn and reduced consumer demand on 1st January 20x2, state no longer needed to employ any more staff, and the conditions of the grant required full repayment. Now, what should be recorded in the financial statements on 1st January 20x2? You got the grant over here, right? So you got the grant over here on the 1st January. It was for 1 million and the life was basically 4 years, right? So basically in year one, grant income recorded was 1 million by 4, that's 250,000, right? So 250,000 was recorded as an income. Now, in the next year, if the conditions are not met and you have to repay the grant, remember, the full amount is repayable, not just the balancing amount or the remaining amount. No, whatever the full amount you got, that whole full amount has to be repaid over here. Number one. Number two is, what you're going to do is you are going to reverse the income that you recorded, and then you are going to reverse your deferred income and you are going to record it as your current liability, right? So technically, you will reduce the deferred income by 750,000 and recognize a loss of 250,000. Recognize the loss, or you can say recognize the expense over here. So that's going to be the option B over here, the relevant one or the correct one over here, right? Okay. Now, moving ahead from here, we have now the investment property with us. Which of the following properties owned by the Scoop Limited or the Scoop would be classified as an investment property? Now, investment property is a real estate property which is held for the sake of the capital appreciation or for the sake of earning the rentals or both, right? And this has to be a real estate property in which you are doing the investment, and the sole reason for the investment is to have the capital appreciation or the rent that you want to earn basically from that point. So, which of the following properties owned by the Scoop would be classified as an investment property? So, we have number one, a property that had been leased to a tenant but which is no longer required and is now being held for resale. Now, it was leased to the tenant, but now it's no longer required, and if it's held for sale, so that is something which we can say that this is the asset held for sale. That's not an investment property. Land purchased for its investment potential. Planning permission has not been obtained for building the construction of any kind. See, this one, land purchase for its investment potential. I mean, you just got the land because of the investment potential, because its value is going to increase. So you haven't got any planning permission or something to construct the building or something, because you're not interested in getting as far as or constructing the building is concerned. You are concerned with getting the potential benefit out of it in the form of the value that it increases, right? So the correct option is technically the B, but let's see the C and D as well. A new office building used as Scoop's head office. It's used by the Scoop, so it's technically gonna be the tangible non-current asset under the IAS 16 over here. And then stately home used for executive training or something, that is again into personal use or something, so that's not gonna be over here as well, right? So it's not going to be over here because that is going to be under the IAS 16 scope. That is the property, plant, and equipment over here. Then we have question number 7 over here. During the current year, an entity had in place 1 million 6% loan finance and 2 million of 9% loan finance. It constructed a new factory which cost 600,000, and this was funded out of the existing loan finance. The factory took 8 months to complete, so the 100,000. What is the borrowing cost that should be capitalized? Okay, straightforward question. We had 6% loan, 1 million. We had 9% loan, 2 million. So the total is 3 million, and the weighted average, this is 1 by 3, this is 2 by 3. In terms of percentage, this is 30 and 3 is 67. So we are now going to have the weighted average of loan interest, which is going to be 0.33 into 0.06 plus 0.67 into 0.09. So that's gonna be 8%, almost 8%, right? So it considered a factory which cost 600,000. So the borrowing cost to be capitalized is 600,000 into 8% into how many times the factory took? 8 months. 8 by 12. 32,000 over here, right? So triple zeros are already over here. So I'm going to take this 32 over here, right? All right. Now, question number 8. Which of the following statements is correct? So I have this statement 1 over here. If the revaluation model is used for property, plant, and equipment, revaluations must be subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value of the asset at each reporting date. So this statement is true over here because you have to do the revaluations on a frequent basis to ensure that the values are up to the par. Second one is when an item of property, plant, and equipment is revalued, there is no requirement that entire class of the asset to which the asset belongs must be revalued. The statement is false over here because this is the requirement that the entire class has to be revalued. So this statement is wrong over here. Then we have this portal company received a government grant of 60,000 on 1st September. The conditions of the grant state that the portal company must employ a local worker on a full-time contract over a 5-year period. Portal company expects to meet the conditions of the grant. The full grant has been recorded as other income for the year ended 30th December 20x4. So what is the adjustment required to account for the grant over here? So we have the account name, bank, other income, total accrued income, total deferred income. So we have the values over here as well. And the grant is total 60,000 over here. The grant is total 60,000. We got it on 1st September. So total value of grant is 60,000, right? You were supposed to record the income for the year end. That would have been 60,000 by 4 years, no? Nah, 5 years. Multiplied by, you got it on September, the year end is December. So September, October, November, December, 4 by 12. 60,000 by 5 into 4 by 12. So that was 4,000 over here, right? So 60,000 minus 4,000 is gonna be 56,000. Yes. So the value is gonna be 56,000 over here. 56,000 over here in both. And now the total amount has been recorded as other income. Now, so we are going to debit the other income. And then we are going to defer income credited over here. So this deferred income, it has to be credited over here, right? So, okay, let me fix it up. This is the accrued income. This is the deferred income. So deferred income has to be accounted for over here, right? So that's going to be the answer. So, we have this question number 10 over here. Come on, hurry up, solve this one for me. Come on, I need a minute only. Solve this question for me. I'm waiting right here. So what's the answer? Have you been able to solve? Anyone? Okay. Nawful got the answer. Let's see. Nawful, you're right. Very good. Tibet acquired a new office building on 1st October. Its initial carrying amount consisted of the land, building, and the air conditioning. The estimated life of the building structure and air conditioning system are 25 and 10 years respectively. When the air conditioning system is due for replacement, it is estimated that the old system will be dismantled and sold for 500,000. Now, depreciation is time portion where appropriate. So, at what amount will the office building be shown in the Tibet's financial statement, statement of financial position at 31st March 20x5? So, we are going to have the land 2000, then we have the building, and the building structure is 10,000 minus it will be sold for 500,000, right? So that is the old system will be dismantled and sold for 500,000, right? So this is the 10,000 over here, and the life is expected to be the 25 years over here. So that's going to be by 25 into, you got it on 1st October. The year end is 31st March. October, November, December, January, February, March, 6 by 12. Right? So building's cost is 10,000 minus by 25 into 6 by 12. So that's going to be 9,800. And the air conditioning system, that is going to be 4,000 by 10 years into 6 by 12. So 4,000 minus 4,000 by 10 into 6 by 12 over here. So that's going to be 3,800 over here, right? Oh, the air conditioning system is basically with the 500. My bad, my bad. I got it. Air conditioning system is sold now. So that has to be 4,000 minus 500 over here. So that's going to be 4,000 minus 500 over here. No, 3,825. So the total is going to be 15,625. Option A. Very good. Then we have this 11 over here. The following trial balance extracts relates to a property which is owned by a Wheaton as at 1st April 20x4. So property at a cost, 20 years original life. We have the debit and credit over here. So property at cost, accumulated depreciation over here. So we are going to have on 1st October 2024 the following: a sustained increase in property prices. Wheaton revalues property to 10.8 million. What will be the depreciation charges in Wheaton's statement of profit and loss for the year ended 31st March 20x5? It has increased the value to 1st October. So October, November, December, January, February, March. It's a 6 months right in the middle of the year. The revaluation has taken place. So original life is 20 years over here. So the depreciation charge for first 6 months is gonna be 12,000 by 20 into 6 by 12 over here, right? And then depreciation charge for next 6 months is the revalued amount. So it has revalued the property. It's on 10.8 million over here. So that is 10.8 million is 10,800 divided by remaining useful life. We got the property over here and we don't have the life over here straight away. Okay, look, if we don't have a straight life over here, now the best thing is 12,000 divided by 20 years. 600 is depreciation charge per year. Accumulated depreciation divided by depreciation charge per year is number of years gone. Accumulated depreciation 3600 by 600 is 6 years have gone. So remaining life is 14 years. So 6 months gone as well. So this is going to be 13.5 multiplied by 6 by 12 over here, right? So 10,800 by 13.5 multiplied by 6 by 12 over here. So that's going to be 400. So the total is going to be 700 over here, right? I hope it's clear. So basically what we did over here, this is, simple and straightforward, that we calculated the remaining life over here on the basis of the accumulated depreciation and the depreciation charge, because we were not given the life over here. No? So we had to, calculate it via the accumulated depreciation which is given to us with the depreciation charge for the year as well. Now we have question number 12. Which two of the following statements about the IAS 20 accounting for government grants and disclosure of government grant assistance are true? Which two statements are correct over here? Number one, a government grant related to the purchase of an asset must be deducted from the carrying amount of the asset in the statement of financial position. A government grant related to the purchase of assets. No, you can record must be deducted from the carrying amount of the asset in the statement of financial position. No, you can record it separately as well. I mean, you have the option that you can deduct it from the carrying value of the asset, but you can record it separately as well. You have the choice over here. It's not a must thing that you have to do. It's not a must thing that you have to do. You have the choice. You can go either way. You can go either way. So this is wrong. B. A government grant related to the purchase of an asset should be recognized in the profit and loss over the life of the asset. Yes, this statement is true over here, because the grant related to the purchase of the asset, it should be recognized over the life of the asset over here. Then the next one is free marketing advice provided by a government department is excluded from the definition of the government grants. True. We didn't get any value over here. This is assistance which is given to all and everyone. And then any required repayment of government grant received in an earlier reporting period is treated as a prior period adjustment. No, not as a prior period. We do the adjustment into the current year. We don't go with the opening only. We straight away record it up into the current year. So this statement is wrong, and this C is correct over here. So the answer is going to be B and C over here. Then we have the 13 over here. 13th is Smiths and Company purchased a new building with a 50-year life for 10 million on 1st January 20x3. On 30th June 20x5, Smiths and Company moved out of the building and rented it out to the third parties on a short-term lease. Okay. Smiths and Company uses the fair value model for the investment properties. Okay. At 30th June 2025, the fair value of the property was 11 million, and then at 31st December, it was 11.5 million. Now, what is the total net amount to be recorded in the statement of profit and loss in respect of the office for the year ended 31st December 20x5? So we have to talk about the amount to be recorded in the statement of profit and loss for the year ended 31st December 20x5. So the building was purchased for 50 with a life of 50 years for 10 million on 1st January. Then on 30th June, you moved out, right? So like after 1.5 years, you moved out. and you rented it out to the third parties on short-term lease. Now, we use the fair value model for the investment properties. On 30th June, the fair value of the property is 11 million. And now at 31st December 20xy, the value is 11.5 million, right? So, if we look over here, we have 30th June. Yeah, we moved out on 30th June out of the building to the third parties, right? So on the 30th June, it's all talking about the net over here. So technically we have to charge the first 6 months depreciation, because from IAS 16 to IAS 40, you were on the IAS 16, so 6 months depreciation is going to be charged over there. So first 6 months depreciation, 10 million by 50 into 6 by 12, that's 100,000 over here. Then gain on property is 11,500, 1, 2, 3 minus 11, 500,000, right? So this is the depreciation for 6 months. That's going to be minus. So my net income is 400,000, option A. Although B was really very appealing to me as well, I was just thinking that this is the straightaway answer. But when I just rolled my eyes again on this net income, then I straight away got the idea that check for the depreciation as well. And yes, we were right. After accounting for the depreciation, we have to record the net income, not the gross income over here, because it's asking about the net income over here. If he would have asked that what amount is going to go into the income statement in relation to the gain on the investment property, right? Then we would have taken the 500,000 as the answer. Okay, now we have question number 14 over here. Gilbert took out a 7.5 million 10% loan on 1st January 20x6 to build a new warehouse during the year. Construction of the warehouse began on 1st February and was completed on 30th November. As not all of the funds were needed immediately, Gilbert invested the 2 million in 4.5% bonds from 1st January to 1st May. So what is the total borrowing cost to be capitalized? Okay. Now, when did the construction of the warehouse begin? It began on 1st February. So my interest cost is going to be 7.5 million into 10% into I got completion in 30th November. So February, March, April, May, June, July, August, September, October, November. February, March, April, May, June, July, August, September, October, November. 10 months. So that's going to be 10 by 12. So the interest cost that's going to be 625. My interest, TEREST, interest income is going to be 7.5 million in 2 million was invested at 4.5% into it invested from January till May, but I cannot capitalize the month of January because the construction work was not started. So this 1 month it cannot be adjusted over here against the borrowing cost. So from the time when I capitalize the interest, this is the time period same that from which I will have the income point of view over here as well, right? So it's gonna be February, March, and then February, March, April. February, March, and April, 3 months only. So it's gonna be 3 by 12. So that's gonna be 22,500 over here. So my net interest is 602,500 over here, right? So that's gonna be 602,500 as my answer over here. Then I have my 15 question over here. Croft acquired a building with a 40-year life for its investment potential for 8 million on 1st January 2023. At 31st December 23, the fair value of the property was estimated at 9 million with cost to sell estimated at 200,000. If Croft Company uses the fair value model for investment properties, what gain should be recorded in the statement of profit and loss for the year ended 31st December 20x3 over here? You got the property for 8 million on 1st January. Then at 31st December 23, the property was estimated at 9 million with the cost to sell. 9 million is what we are going to have the fair value. We don't take up the NRV, we take up the fair value over here. So this is 9 million, this is the 8 million over here. So that's going to be simple. 9 minus 8 is 1 million as my gain over here. As my gain, I will have this 1 million over here. Then I have question number 16. This is for the intangible assets, for the research and development thing over here. So which of the following cannot be recognized as an intangible non-current assets in the GHK's consolidated statement of financial position at 30th September 20x1? GHK spent 132,000 developing a new type of a product in June 2021. Management worried that it would be too expensive to fund. The finances to complete the project came from a cash injection from a benefactor received in November 20x1. Uh-oh. We got the cash in November. Year end is 30th September. So this cannot be capitalized as an intangible asset over here, right? Because at the year end, like, we have read about this intangible asset. We have 6 clauses to be met over here, and out of the 6 clauses, the sixth one is the resources available to complete, which is related to the finance as well. So if it's not available, if it's not complete, then you cannot record it up as your asset over here, right? So we cannot record it up as an asset over here. For the B, C, and D, let's see. GHK purchased a subsidiary during the year. The fair value exercise, it was found that the subsidiary has a brand name externally acquired, we can record. GHK purchased a brand name, explicitly bought the brand, record as an asset. GHK spent 21,000 during the year on the development of a new product after the management concluded it would be viable in November 20x0. The product is launched on the market on 1st December. Fine. You are sure about at the year end that it's going to be a profitable. So yes, you can capitalize. So it's going to be option A, where you are not yet sure about what to do over here, right? Okay. Now we have question number 17. Which of the following could be classified as a development expenditure in M's statement of financial position as at 31st March 20Y0 according to IAS 38 intangible assets? Which of the following could be classified as a development expenditure? Can be classified. 120,000 spent on developing a prototype and testing a new type of propulsion system. The project needs further work on it as the system is currently not viable. No, you are still into the research. It cannot be capitalized. A payment of 50,000 to a local university engineering faculty to research the new environmental friendly building techniques. No, it's a research. 35,000 developing on the electric bicycle. This is a near completion and the product will be launched soon as the project is first of a kind. It is expected to make a loss. No, I mean, we need to have the resources available to complete along with, like, it should be profitable as well. So it cannot be recorded as an asset over here. So D is D is technically going to be the answer over here because this is the last one over here. So yes, this is going to be the correct option. Why? Because 65,000 developing a special type of new packaging for a new energy efficient light bulb. The packing is expected to reduce the AMS distribution cost by 35,000 a year. Yes, by this you are getting a benefit. So yes, this should be capitalized over here. Then we have the question number 18. Which two of the following factors are reason why the key staff cannot be capitalized as an intangible asset by the entity? Which of the following two reasons why the staff cannot be capitalized? They do not provide the expected future benefits? No, they do provide the future economic benefit. They cannot be controlled by the entity? Yes, the staff cannot be controlled. Their value cannot be measured reliably? Yes, their value cannot be measured reliably. They are not separable from the business as a whole? They are separable from the business. I mean, if the staff goes home, yes, they are separable. But the point is, they cannot be controlled over here. The value cannot be measured reliably. How valuable a staff member is going to be for you, this is something which is, you cannot calculate. Then we have 19 over here. AMCO carries out the research and development in the year to ended 30th June 25. AMCO company incurred a total cost in relation to the project of 750,000, spending the same amount each month up to 30th April 25 when the project was completed. So basically, you spent 750,000 each month up to when the project was completed, and then the product produced by the project went on sale from 31st May. Okay. The project had been confirmed as a feasible from 1st January, and the product produced by the project was expected to have a useful life of 5 years. So, what is the carrying amount of the development expenditure asset over here? So, you need to find the carrying amount over here, right? So, the project was feasible from 1st January. It was completed on 31st May because it went on to the sales, right? So January, February, March, April, May. January. Yeah, the 30th June is the year end. Till 30th April, right? You came to got sure that it's gonna be feasible for you. So January, February, March, April. Until 30th April you are, no, not till 31st May, till 30th April you are. So 4 months. So 4 months are you going to have over here? So 750,000 into 4 is 3 million over here. 3 million is something that you are going to have over here, right? And then we are going to, what is the carrying amount of the development over here? Not the development expenditure of the asset over here. So we went on the sale from 31st May. So it's just a 1 month over here, right? It's just a 1 month over here that you had over here now. So amortization is for 1 month, 5 into 1 by 12. 50,000. So that's gonna be 2950. Why are we only having this 295,000 over here? Why not 2950? Oh, is it because the total amount is 750,000? Hmm? Total cost in relation to the project X was 750,000, spending the same, but the same amount is spent for each month. So 750,000 into 4 should be 3 million. I believe this is some sort of a typo error or something. What do you say? Or else, let's say you spend 750,000, same amount each month up to 30th April. So from 30th June till 30th April. Technically it would have been from this is 30th June over here, right? Incur the total cost in relation to the project X 750,000 spending the range up to 30th April 20 when the project was completed. The product produced by the project went on to sale. Confirm feasible on 1st January. Useful life is 5 years. I believe this is a typo error over here because I can't see anywhere. Like let's say this is 750,000 for the total, right? So 750,000 total for how many months? I mean, how am I supposed to get an idea that for how many months, these have been incurred over here? Because if, okay, fine, each month spending the same amount each month up to 30th April 2025 agreed upon. But from what time? But from what time you were spending this amount? Because the project had been confirmed as feasible from 1st January now. So this is the time period from when I can capitalize the cost. For if I have to assume that 750,000 is the total cost, then for how many months? It's not mentioned anywhere. So I'm assuming this 750,000 is per month, and same amount is spent every month, 750, 750, 750, 750. So by this, I have the 750,000 into 4. That's going to be 3 million. So I minus my amortization and I get 2950. So most probably it's a typo error over here. Otherwise, if I have to go on some number of months basis or something, then it should have mentioned at least that if the project was completed on 30th April, then when was the project started, by the way? When was the project started? At the start of the year, we started off. This is something I can assume. In the year ended 30th June 2025, AMCO incurred a total cost in relation to a project of 750,000, spending the each amount each month. This is something I can try to assume over here that from 1st July, I started spending. So July, August, September, October, November, December, January, February, March, April. By this I can have the 10 months over here, but it's not mentioned anywhere. It's not mentioned anywhere that you started from the start of the year. I mean, might be possible you started it last year as well. It's not mentioned anywhere. So the wording is vague over here, but don't worry, you are not going to have such wording in the paper. So don't worry about it, okay? Let's go with the question number 20 over here. Cybele has acquired a subsidiary Basel in the current year, but I'm sure the answer is correct. I'm 100% sure. I mean, you can check the reference to the exam pit as well. I'm 100% sure the answer is correct. It's just that I have an extra zero over here, right? Because if I assume by the 10 months, let's see, 750,000 by 10 into 4. So 750, 1, 2, 3 by 10 into 4. Okay. I got this 300. So amortization is now going to be what of 5,000? Because if I less one zero, yes, now I have the correct answer. By assuming, so I get 295. Okay, this is the mystery for the zeros. So I'm assuming that it's for the 10 months. I mean, the question is not me. The question is assuming that it's for 10 months. So that is how, the answer of 295,000 is being calculated over here. But it's again a vague wording. You cannot expect to have such a question in the paper. Such vague wording is not going to be there in the paper. Don't worry. Question 20. Cybele has acquired a subsidiary Basel in the current year. Basel has a brand which has been reliably valued by the Sable at 500,000 and a customer list which Sable has been unable to value. Which of these describes how Sable should treat these intangible assets of Basel in their consolidated financial statements? They should include it into the goodwill. No, no. The brand which has been reliably valued, it should be recorded as a separate asset. Whereas the customer list, I mean, if you're not clear about it, then yes, that is something which you can include into the value of the goodwill. Option B. The correct answer is going to be the option B over here, that the brand should be capitalized as a separate intangible asset, whereas the customer list should be included within the goodwill. Option B is going to be the correct one. Both the brand and the customer list should be capitalized? No. The customer list should be capitalized as a separate intangible asset, whereas the brand should be included. No, 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 no. The brand should be capitalized as separate, and customer list should be included in the goodwill. Then I have this 21 over here. Dempsey Company owns a pharmaceutical business with the year end of 30th September. Dempsey commenced the development stage of a new drug on 1st January 20x4. So 40,000 per month was incurred until the project was completed on 30th June. See over here, the dates are properly mentioned. From 1st January to 30th June, you spent 40,000 a month. When the drug went into immediate production, the directors became confident of the project's success on 1st March. The drug has estimated life of 5 years. Time apportionment where appropriate. What amount will the dams charge to the profit and loss for the development cost, including any amortization? So we are going to have the research cost. We became confident on 1st March, so January, February, 2 months. Then March, April, May, June. 4 months capitalized divided by life is 5 years into it went 30 June, now it went into the production. So after June, it's July, August, September, 3 months. So it's gonna be 40,000 into 4 by 5 into 3 by 12, 8,000 as well. So total is 88,000, which we should charge into as far as the income statement is concerned, right? All right. So this is what we are going to have over here, right? Okay, now let's have a break. Have a break of 4-5 minutes or so. We're going to come back and then we are going to resume. Let's have a break. And the second thing that we are going to start are the scenario-based questions from the section B. But let's have a break first. Let's just walk around a bit, then we're going to come back and then we are going to resume over here. Let's have a break. Okay, I'm back. So let's assume now. Here we go. Yes. Okay. This is a section B type question over here. Flightline is an airline which treats its aircraft as a complex non-current assets accounted for under the historical cost model. The cost and the details of an aircraft are interior cabin fittings installed on 1st April for 25,000 or 25 million. Estimated life is 5 years. Engines installed on 1st April are for 9 million, 36,000 flying hours. In the year ended 31st March 2018, the aircraft flew for 1,200 hours for the 6 months to 30th September 20x8. On 1st October 20x8, the aircraft suffered a bird strike accident which damaged one of the engines beyond repair. This was replaced by a new engine with a life of 36,000 hours at a cost of 10.8 million. Flightline year end is 31st March. So, what is the depreciation charge, or what is the depreciation to be charged in respect of the engine for the 6 months period to 1st October 20x8? This is on 1st October. We bird strike accident. So the engine flew for 1,200 hours, right? Total is 36,000 hours. So depreciation charge on engines up to 1st October 20x8 is 9,000 by 36,000 into 1,200. So 9,000 by 36,000 into 1,200 is going to be 300. So this 300,000 is going to be the answer over here. Then, which of the following explains the correct accounting treatment of the engine? So what happened? We had a bird strike accident. So after the bird strike accident, the engine was damaged beyond repair. This was replaced by a new engine with a life of 36,000 hours at a cost of 10.8 million. So it was replaced by a new engine with a life of 36,000 hours. So over here, what we can do is, which of the following correctly explains the accounting treatment of the engines? Write off the damaged engine, capitalize the new engine, and depreciate it over 24,000 hours. No, the life of the new engine is 36,000 hours, right? So it cannot be done like this. Then treat the 10.8 million as a repair to the damaged engine and continue to depreciate the engine at the first 6 months. No. Capitalize the 6 million to replace the damaged engine. No. Write off the damaged engine, capitalize the new engine, and depreciate over the 36,000 hours. Yes. This is the correct option over here, the D, right? Because, we are going to capitalize the new engine over here, and then we are going to depreciate it over 36,000 flying hours over here, right? All right. Then the next part is 228. A wing was also damaged but was repaired at a cost of 3 million. The accident also caused a cosmetic damage to the exterior of the aircraft, which required a repainting at a cost of 2 million. Identify the correct treatment for the 3 million repair cost at the wing and the 2 million repainting the aircraft. As far as the repair is concerned, the repair is going to be the expense over here. Then we have the 2 million repainting of the exterior. This has to be the expense as well, right? So both of these are gonna be expenses over here. Then 229, as the aircraft was out of service for some weeks, due to the accident, the flight line took the opportunity to upgrade its cabin facilities at a cost of 4.5 million over here. So cabin facilities were upgraded at 4.5 million. This did not increase the estimated remaining life of the cabin fittings, but the improved facilities enabled the flight line to substantially increase the airfares on this aircraft. So this is now approved over here, approved as in a sense, these are the improved facilities, right? Because of which you were able to charge the extra, like, revenue, and you were able to charge extra from the customer. So this has shown an increase in the performance of the aircraft, and the performance has been enhanced because of which you are able to get the extra revenue and all. So this will be capitalized over here. This will be capitalized over here. So what is the carrying amount of the cabin fittings at 31st March 20x9? Okay, the year end is 31st March 20x9. So we have the interior cabin 25 million over here. Okay, so cost is 25 million. Life is 5 years. And it was replaced on 1st April 20x5. Now the year end is 31st March 20x9. X6, 7, 8, 9. So 4 years are gone, right? So if 4 years are gone, so technically speaking, carrying value, or I can do it, cost 25 million, accumulated depreciation 25,000 by 5 into 3. We have carrying value at start of the year. My bad, my bad. 25,000 by 5 into 3. So that's going to be sum of 10 million over here. Right, then depreciation first 6 months, 25,000 by 5 into 6 by 12. Then we are going to have capitalized cost. So capitalized cost is 4.5 million, right? So 4.5 million is going to be 4,500 over here. Then total value is going to be 12 million over here, right? And then depreciation for next 6 months. So 12 million by 1.5 year is now remaining, right? So into 1.5 or yeah, into 6 by 12. So 4,000. So I am going to have the carrying value at year end. So it's gonna be 8 million over here, right? So this 8 million is going to be my correct answer over here. Then the bird strike accident represents an indication of impairment. Complete the following sentence from the choice below. The aircraft will be impaired if its dash exceeds the recoverable amount. If its carrying value exceeds its recoverable amount over here. So carrying amount is basically going to be the correct answer over here, right? Okay. Now let's just go to the next question. And this is from the next scenario. So here we go. Now, Speculate owns 2 properties and uses fair value accounting where possible. Property A. An office building used by the Speculate for the administrative purposes at 1st April 20x2. It had a carrying amount of 2 million and a remaining life of 20 years. On 1st October 20x2, the property was let to third party and reclassified as an investment property. The property had a fair value of 2.3 million on 1st October 20x2 and then 2. 34 million at 31st March 20x3. Then the property B. Another office building let on a 12-month lease to a subsidiary of Speculate on 1st April. It had a fair value of 1.5 million, which had risen to 1.65 million at 31st March 20x3. So, what's the correct treatment when property A is reclassified as an investment property? So, correct treatment when a property A is reclassified. So, in this case, the property on 1st April had a carrying amount of 2 million and the life of 20 years on 1st April. Okay. Then on 1st October it was transferred. Now, so on 1st October, what was the carrying value? Let's see. So it was by 20 into April, May, June, July, August, September, 6 months. 50,000. So 2 million is here. We have to minus this. So we get this is 2 million by 20 years. Yes. And then the 6 by 12 as well. Done, done, done. So we are going to have 1950. So 1950 is the carrying value, whereas the fair value is 23 million. No, 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 no. Yeah, 2.3 million, 2.3 million. My bad. It's correct. So the gain in between is this minus this is 350,000. So when the property is taken up from the IAS 16 to the IAS 40, the gain of this 350,000 is going to be taken to the other comprehensive income. Option A is correct over here, right? When the property is shifted from IAS 16 to IAS 40, whatever the gain that we have, it is going to be taken to the other comprehensive income. Okay, it will be taken to another comprehensive income. Done? Okay. Now, which of the following models can speculate use to account for investment properties in its individual financial statements? So, which of the following models can speculate use to account for the investment property? Investment property can be accounted for as far as the cost model is concerned, and it can be accounted for as a fair value model as well. Revaluation is not used on this, right? So, cost model and fair value model, right? So, this is what we are going to have over here. So, for this, the correct option is going to be option B over here, right? And then we have the next one, 233. What is the total gain for investment properties to be included in Speculate's individual statement of profit and loss for the year ended 31st March 2023? Total gain. So in the individual accounts, I mean, if I have to go, let's just go up and solve it over here and then we'll paste it down. So we have this 2.34 and this is the value at 2.3 now. So this is going to be property A. 2.34 million minus 2.3 million. So 2340,123 minus 2300,123. So we have this 40,000 over here, then property B 1.5 to 1.65. 150. So yeah, so 190. So I'm gonna have this 190,000 over here. All right, okay. Then I have 234. In the individual and consolidated financial statements of speculate, how would property B be accounted for in the individual and the consolidated accounts? In the individual accounts, obviously, this is going to be the investment property, but in the consolidated account, it has been given to the subsidiary now. So from the group's point of view, it's under use. So technically, that's going to be the property, plant, and equipment over here. And then what would be the carrying amount of the property A at 31st March 2028? So if speculator use the cost model for the investment properties. If it had used the cost model, then at 31st March, it would have been the property had a fair value at the end. Okay. Now the property was converted at 2.3 million over here, right? No, this is the property had a fair value over here, right? So, but this is the fair value, no? This is the cost model. So if you have continued, this would have been 2 million by 20 years. So 2 million by 20 years is, that's 100,000 then. 1900. This is the answer over here, this one, right? Because if it's a cost model, then obviously it would have been on straight away this one over here. All right, I hope it's clear to you. Okay. Moving ahead, let's see the other question. The following scenario relates to question 236 to 240. Okay. The following issues relating to chestnut companies' non-current assets are outstanding for the year ended 31st December 2007. Factory. At 1st January 2007, Chestnut Company's factory had a carrying amount of 5 million. Okay. It has a remaining useful life of 10 years on that date. So remaining useful life is 10 years at that date. So on 31st December 2007, there was an impairment review of the factory and the recoverable amount was deemed to be 2.5 million. Okay. So the impairment review, the recoverable amount is 2.5 million. Chestnut Company's factory had been previously revalued upward and the revaluation surplus has a credit balance of 1 million relating to the factory. Okay. Then we have the head office and then we have the machinery as well. So the first question is, which of the following assets belonging to the Chestnut Company required an annual impairment review? So the factory, okay, so at 31st December, there was an impairment review, now. So first thing first, carrying value of factory at year end is, that's 500,000, 5 million. So the carrying value is 450,000, 4,500,000 over here. Okay. Recoverable amount 2.5 million. So yes, factory needs to be checked for the impairment over here. Head office. Chestnut head office cost 12 million 1st January 20x1 and is being depreciated over 40-year life. On 31st December, there was an impairment review and the head office and the recoverable amount was deemed to be 9 million. Okay, recoverable amount is 9 million. A most recent valuation, 31st December, had estimated that the recoverable amount of the head office is 11 million. So at 31st December, the recoverable amount is 11 million. The cost is 12 million. So the carrying value this is 11,700 over here. This is on 1st January 20x1 and then at x4. So x1, x2, x3, x4. 4 years depreciation. 4 years depreciation. Accumulated depreciation is what I have to take. So that's going to be 10,800 and the recoverable amount is 11 million. So carrying value is lower than the recoverable amount. No impairment. It's fine over here, head office. Then the machinery received a grant of 2.6 million towards the new production machinery. The machinery cost 4 million, expected to use for 5 years. Depreciation is charged in a straight line proportion. Chestnut Company uses the cost model when accounting for its head office and the deferred income related to the government grant. So it received a grant. So what? So what if it received a grant? Then, so which of the following assets belonging to the Chestnut require an annual impairment review? Annual impairment review, head office, machinery. Okay, neither the head office nor the machinery. There is no issue with them. So it's fine, right? So we are not going to do anything. Then in 237, in accordance with IAS 36 impairment of assets, what is the correct journal entry? What is the correct journal entry to reflect the depreciation and the impairment of Chestnut Company factory for the year ended 31st December 20x7? Impairment of assets for the journal entry for the factory over here, this factory. So the recoverable amount is 2.5 million. I'm going to go here. Recoverable amount is 2.5 million. We have the carrying value 4,500,000, and then we have a revaluation over here of 1 million. Revaluation of 1 million as well. So we have to talk about that what journal entry is required to reflect the depreciation and the impairment of the asset over here. Now, as far as this is the carrying value, this is the recoverable amount. So total impairment is 4,500 minus 2,500 is 2 million over here, right? And this carrying value is on 1st January. No, I have calculated the carrying value at the year end. Okay, so 500,000 has been charged for the depreciation. Recoverable amount is 2.5 million over here, no? The carrying value is 4.5 million. So total impairment is 2 million over here. Okay. Factory. Let's cross check this one for a second. 5 million is here, the carrying amount. It had a remaining life of 10 years at that date. So on 31st December, there was an impairment review. The recoverable amount was 2.5 million. Right, so 4.5 million with the 2.5 million, total impairment loss is going to be of the 2 million over here, right? Now, with this 2 million, how are we supposed to record? The asset is going to go down, right? the asset is going to have a credit of 2 million over here. The debit is going to be the revaluation reserve with 1 million over here. And the debit to income statement is going to be of 1 million over here, this one, right? This is related to as far as the impairment double entry is concerned, right? Now, as far as the depreciation charge is concerned, which is 500,000, so we are going to debit the depreciation expense, or we are going to debit the income statement with 500,000, we are going to credit the asset with 500,000 over here, right? So in total, income statement is going to go over here. Asset is going to get more of a credit over here. So that's going to be 2.5, and the income statement is going to be 1.5. So 1.5, 1 and 2.5. The total answer is going to be option A over here, right? This is for the impairment. This is for the double entry, separate entries, huh? But obviously, the options are with the combined entry over here. So that is what you are going to do over here. Done? Okay. Then what is the carrying amount of the Chestnut's head office in the statement of financial position? Head office. This is the head office over here. And I have calculated the carrying value of the head office over here. So I'm just gonna paste it over here. So that is then 800 over here, right? And let's just cross check it again. Chestnut head office cost 12 million 1st January 20x1 and is being depreciated over a 40-year life. Okay. On 31st December, impairment review, the head office and the recoverable amount is 9 million, right? And then a more recent revaluation, or sorry, recent valuation has estimated that the recoverable amount of the head office is 11 million over here. So head office. 12 million 40-year life, 4 years are gone. Okay. Head office's cost is 12 million. Depreciation is by 40 into 4 years, 1.2 million. So we are going to have the carrying value at 10.8 million, right? So this is going to be 10.8 million over here. Done. And then if I go with the as far as the carrying amount of the concern, the head office would have been impaired down, because at first when we would have checked the impairment at earlier, that was 9 million over there now. So it would have been charged to the statement of profit and loss. So obviously the valuation at 31st December 20x7 means that there is a reversal of this original impairment loss, right? So technically this is recorded at 10.8 million. First impairment check. First impairment check we did, the amount was 9 million, right? So impairment loss recorded is 10.8 minus this. So we would have recorded this 1.8 million over there. Then fair value of the recoverable amount. The recoverable amount would have been 11 million over here. right? And now we have recorded the value at 9 million over here, right? So overall speaking, how much extra we would have had recorded it up over here? And this is something we are simply going to account for. Like, let's say this is the 12 million, huh? This is the 12 million over here, because on 31st December, the impairment review, it recorded it at the 9 million. Now at 31st December, it's at 11 million. So 5, 6, 7, 3 years extra depreciation has been charged on the 9 million over here, right? So if 3 years depreciation has been charged, so what we are going to do over here is we are simply going to calculate the depreciation that has been calculated for these 3 years, right? So that is going to be the 3 years which have been charged. So that's going to be 12 million cost by 40 into 3. That's 900,000 over here, right? So that is 900,000 which would have been charged over here as the impairment. Nah? So this was the carrying value. So 9 million carrying value after impairment in the accounts, plus depreciation reversed if no impairment would have been charged. So that's going to be 9 million plus 900,000, and the answer is going to be 99,100,000 over here. Now, the story. If I go with the story over here, the rule is simple, that if you have an asset which is being impaired over here, and then that impairment is reversed in the future, you only reverse it up to the amount that original carrying value would have been if there was no impairment. So you are going to assume that there is no impairment. You are going to charge the depreciation. You will calculate the amount of the depreciation, and up till the amount of the depreciation, the impairment is going to be reversed or something, right? So this is what the approach you are going to have over here for this. Done? Okay. Now, 239, which of the following statements relating to government grants is correct? Which of the following statement related to government grants is correct? The deferred income method should always be used for grants related to assets. Note, it's not necessary that you can only go for the deferred. You can go for the net of method as well. Grants related to income must be disclosed separately in the statement of profit and loss as other income. Why to separately disclose them? They are simply shown in the other income. The deferred income method should only be used if the grant is repayable. No, we can use anytime we want to. The grant related to asset can be accounted for using either the deferred income method or by deducting the asset's carrying amount. Yes, this is true. So the correct answer is going to be D over here. And then what is the carrying amount of the non-current liability in respect of the government grant and the adjustment company's statement of financial position at 31st December? Carrying amount of the non-current liability in respect of the government grant over here. So we are going to solve it here and then paste it over there. Look, we have the total grant received 2.6 million, right? This is on 1st April 20x7. Now we are going to have the recognized income, right? And the recognized income is going to be 2,600 by 5 into we got it on 1st April, year end is December, January, February, March. So 3 months is not there. So it's going to be 9 by 12. So the recognized income is going to be deducted from here by 5 into 9 by 12 is 390. So you get a total balance that's going to be double 210, right? Then from this is the total balance. You're going to less the current liability. Current liability is the amount that's going to be recognized in the coming 12 months. So that's going to be 2,600,000 by 5. 2,600, 1, 2, 3 by 5. And then remaining balance as non-current liability is 1,690 as the answer. Done? Okay. Moving ahead. Now we have this 241 over here, and we're just starting in 2 minutes. Okay, I'm back. I'm sorry for the hold. So this is the question which is related to 241 to 245. Whether a company has the following research projects at 31st March 20x7. Project 324, the project commenced on 1st April 20x6 and incurred total cost of 15 million during the period to 31st December 20x6 on a pro rata basis. On 30th June 2026, the directors were confident that the project would meet the capitalization criteria of IAS 38 intangible assets. The project was completed and began to generate revenue from 1st January 20x7. It is estimated that the project will generate the revenue for 5 years. Then we have project 325. The project commenced on 1st September 20x6. Cost of 20,000 per month were incurred until 31st January and the project was when the project was abandoned. Okay. So this project was abandoned. The specialist equipment had been purchased for project 325 was transferred to use in another of the Wellrop company's research projects. Then the project commenced on 1st January 2027 for the project 326. Cost of 40,000 per month were incurred until 31st August when the directors increased the spend to 60,000 to complete the project quickly as a potential buyer had been identified on 20th July. So the directors had not been confident of the success of the project until this point over here. So which two of the following are required by IAS 38 intangible assets in relation to the amortization of intangible assets excluding the goodwill? What two things are required? Number one, intangible assets should be amortized over the expected useful life or not at all if the useful life is deemed to be indefinite. True. I mean, you normally amortize it over the useful life, and if the useful life is indefinite, then technically speaking, you don't need to amortize them. Agreed upon. Second is B is intangible assets should not be amortized, instead reviewed for the impairment losses. No, the intangibles with the indefinite life, they are normally checked for the impairment. C is intangible assets should be amortized on the basis of the expected pattern of consumption of the expected future economic benefits. Intangible assets should be amortized on the basis of the expected pattern of consumption of the expected future economic benefits. True. I mean, how you are going to have the pattern of consumption, according to that, you decide to amortize it. And then the intangible assets should not be amortized or impaired and instead simply carried forward at their original cost until sold or scrapped. No, it's wrong. They are amortized over their life. Then 242, which two of the following statements are true in relation to IAS 38 intangible assets? Number one, IAS 38 required the revaluation of intangible assets where entity has chosen to revalue its intangible non-current assets. Normally, if we talk about as far as intangibles are concerned, normally we report them at the cost, not at the fair value, because technically the active market is a bit question related to the intangibles, right? So normally we have them at the cost. So saying that it requires you to revalue the intangible assets where the entity has chosen to revalue its intangible non-current assets, where the entity has chosen to revalue its tangible non-current assets is not going to be applicable over here because one is IAS 38, one is IAS 16, so they cannot have the same adoption over here because they are independent of each other. Then IAS 38 does not permit the revaluation of intangible assets in any circumstances. So no, it does permit. I mean, if the active market is over there, you can go and you can revalue. C is IAS 38 permits the revaluation of intangible assets only if there is an active market for such assets. True. We can have the revaluation if an active market is there. And then IAS 38 requires the initial recognition of the intangible must be at cost. So this is true as well. Then 243. In accordance with IAS 38 intangible assets, what is charged to the statement of profit and loss for the year ended 31st March in respect of the project 324? So what should be charged to the profit and loss in respect of the project over here? So the project incurred total cost of 15 million. Then on 30th June, the directors were confident that the project will meet the capitalization criteria. So cost capitalized July to December, 6 months. So this is going to be 6 by total is from April to December, 9 months. So 10 is going to be deducted over here. Then we have cost of research expense over here. So the cost of research expense is going to be 5 million over here. Right? And on 30th June, right? So we are now going to have the amortization, and the amortization is going to be 10 by 5 years. And from 1st January started to give the revenue over here, right? So the year end is 31st March, January, February, March. It's 3 by 12, so it's 1 million over here. Technically 0.5. So total charge to P&L is 5.50 over here. So I'm going to take it down over here. So 5.5 is what we are going to have as our answer, option A. Now, project 244. In accordance with IAS 38 intangible assets, which are the following is or are true or false in respect of the accounting treatment of project 325 and 326 over here. Overall speaking, the cost of the project 325 should be expensed in the statement of profit and loss. Yeah, the project was abandoned, so yes, the cost has to be expensed out. True. The specialist equipment was purchased for project 325 should not be depreciated as it has been used and abandoned. No, the project is the equipment is going to be depreciated. This is false. Then the cost of the project 326 should be included as an asset in the statement of financial position at 31st March. No, when they got the buyer, then they got to know about it. So 31st March, it cannot be capitalized. It cannot be. So it's going to be false over here as well. Then during the year ended 31st March 2028, Wellrope Company incurred the following costs 1, 2, 3. So which of the above costs would be capitalized as intangible assets over here? So 400,000 in staff cost incurred in updating a computerized record of potential customers. Internally generated asset, not capitalized. 800,000 for the purchase of a domain name for the website of an entity making substantial online sales. This is an asset. 4 million for a patent purchase to improve the production process with an expected useful life of 3 years. Yes. 2 and 3, option C. This is going to be the correct answer over here. Right? So this is going to be the correct answer. Okay, let's move ahead. We have the next part over here. This is now the 251 that we have. The following scenario relates to questions 251 to 255. A Bina company prepares the financial statements to 30th June each year. During the year to 30th June 2025, the company spent 550,000 on the new plant as follows. Plant cost, delivery, building, cost of initial testing, and plant operator training cost. Okay. Now, Avina Company's fixtures and fittings were purchased on 1st July 2022 at a cost of 50,000. The directors have depreciated them on a straight line basis over an estimated useful life of 8 years, assuming a 5,000 residual value At first, July, the directors realized that the remaining life of the fixture was 5 years. Okay, there is no change in the estimated residual value. So life has been revised over here. And then Abina began a research project on October 2023 with an aim of developing a new type of machine. If successful, Abina company will manufacture the machines and sell them to customers, as well as using them in their own production process. So during the year ended 30th June 2024, the cost of 25,000 were incurred on conducting the feasibility studies and some market research. During the year ended 30th June 2025, a further 80,000 was incurred on constructing and testing the prototype of the machine. So question number one, in accordance with IAS 16 property, plant and equipment, what is the value of the additions to plant for Abina company? Value of addition to the plant. Value of additions. So 550,000, right? So we are going to have the plant cost 525, delivery with the 3, building alterations 12, initial testing with 2 only, right? Operator cost is something we are not going to have. So that's going to be 542. This is the answer. Then, which of the following is true in relation to the change in the remaining useful life of the fixtures and fittings? Change in the life is basically a change in accounting estimate over here. So it's not an issue. From now onwards, you will apply the change. It's a change in accounting policy. No, it's a change in accounting policy. No, it's a change in accounting estimate. Not retrospective. It's prospective change, basically, right? From now onwards, prospective change. This is what we have, right? Retro means from back till day one, from day one, right? Prospective means from now onwards. Then in accordance with IAS 16, what is the depreciation charge for the fixtures and fittings for Abina company for the year ended 30th June 20x5? Fixtures and fittings for 30th June 20x5. 30th June 20x5, 30th June. So if we look over here, we got it on 1st July. 50,000 minus 5,000, life is 8 years. So 45,000 divided by 8 is 5625. So this is gonna be x3 and then x4. 2 years gone. 2 years gone. This is accumulated depreciation. So carrying value is 38,750. Now, the directors believed that from this day onwards, the life was 5 years. So this is going to be 38,750 minus 5,000 divided by 5 years. 38,750 minus 5,000 by 5 years is 6,750, right? Six seven five zero. 254. In accordance with IAS 38 intangible assets, what is the correct treatment of the 25,000 cost incurred on the research project by Abina company during the year ended 30th June 2024? The research cost. Let's go and check again. Okay, so a Bina company will manufacture and sell the machines to customers as well as using them in their own production process. The cost of 25,000 were incurred on conducting the feasibility studies and some market research. So this is the cost. And then a further 80,000 was incurred on constructing and testing a prototype of the machine. Okay. If successful, they will sell to the customer. So this is also going to be expense out as well. Right? So I'm going to go over here. So in accordance with IAS 38, what is the correct treatment for this? 25,000, this 25,000, which has been incurred, right? So this is going to be, the project has moved to the development stage. No, the project is still in the research stage. So the project is still in its research stage, and the 80,000 cost incurred by the winner company cannot be recognized. Okay, sorry, I was in this question. In accordance with IAS studies, what is the correct treatment for this 25,000? They should be recognized as an intangible asset. No, they cannot be. The project is still in the research stage. This is a research, it has to be expensed out. So they should be written off to profit and loss as an expense as they are research costs at this date. So this statement is true over here, 254. Then we have this 255. In accordance with IAS 38, which of the following is true when a Bina company moves to the production and testing stage of the prototype? Production and testing stage. Testing stage is still a research. It cannot be capitalized until the commercial production starts. So it has to be expensed out. So the project has moved to the development stage. No. The project is still in research stage and the 80,000 costs incurred by the Bina company cannot be recognized as an intangible asset. Option B. Option B is going to be the correct one over here. Right? Okay. Now, let's have this next one over here. Scholler constructed a furnace on 1st April 23, causing significant environmental damage, which must be repaired at the end of the asset's life of 10 years. The present value of this is estimated to be 4 million. Scholler has a cost of capital of 8%. Okay, so question number 1, 256. What is the total finance cost to the nearest thousand to be recorded in the statement of profit and loss in respect of the environmental damage caused by the furnace for the year ended 31st March 20x4? So the present value is 4 million, cost of capital is 8 million, 4 million into 8% is 320, right? So 320 is going to be my answer over here. Then, what is the non-current liability? What is the non-current liability in respect of the government grant to be shown in the Scholar statement of financial position? Okay. So Scholar received a government grant of 1.2 million relating to the cost of the plant with a 5-year life. Scholar account for the grant using the deferred credit method. You got it on 1st October. Year end is 31st March, October, November, December, January, February, March. 6 months gone. So it is for a 5-year life. This is something recorded as income. This is remaining balance. So I have to talk about the non-current liability. So this is the remaining balance total. Now, from this, again, I can do is by 5. This is the current portion. So non-current portion will be total minus this 8400. So this all taken from here, pasted here, and this all gone with a comma So 840,000 is going to be my answer over here. This one, right? Then, what is the carrying amount of the land to be shown in the statement of financial position of the Scholar at 31st March? Carrying amount for the land. On 1st October 26, Scholar also acquired a land for 12 million dinars. The land was used to construct a factory during the year. Scholar's functional currency is the dollars. So you got a land over here. So at the year end, yeah, carrying amount of the land to be shown in the financial position. So at the year end, it's translated at the closing rate over here. So it's 12 million dinars by exchange rate 3 dinars to $1, nah? So if it's 3 dinars to $1, I am going to multiply it with no, this is for the 12 million dinars, right? So divided by 3. Okay. I'm gonna have it over here. There we go. So that's gonna be 4 million, right? Then I got it 12. I have to carrying amount of the land na, at 31st March 24. So at 31st, the exchange rate was at 31st March. I've taken the wrong exchange rate. I've taken the average rate over here. 31st March, the exchange rate was 2 dinars against $1. My bad. My bad. This is by 2. So that has to be by 2 over here. No. The exchange rate has to be on 1st October 23, the exchange rate was 4 dinars at $1 on 1st October 23. So I am going to have it at the opening rate over here. Yes, because when I got the rate is basically 4 million. Yeah, this is what I was doing. So that's gonna be by 4 is 3 million over here because land is basically a non-monetary asset now. So it's gonna be staying at the original investment that you did over there, right? In the consolidation, normally we retranslate it, but not over here in the individual accounts. Then the 259, the costs below are the costs associated with the construction of the factory. So which of the following cannot be capitalized? Legal fee relating to the site purchase, capitalized. Health and safety training for new construction workers. Look, this health and safety training cost is something that we cannot capitalize. So it's going to be option B. Direct labor cost is capitalized, cost of site preparation is capitalized as well. Then in the following year, it was discovered that the Scholar had breached the conditions relating to the government grant and therefore the grant had to be repaid. Which two of the following describe the correct accounting treatment to record the repayment of grant? A. Remove all the deferred income balances. True. Record an expense in the statement of profit and loss. Yes. Increase the cost of plant. No. Make an adjustment to the prior year. No. Only remove all the deferred income and you have to record the expense in the statement of profit and loss. That's it. This is what you are gonna do over here. All right, I'm gonna stop over here. We are almost done with as far as the asset family and everything is concerned, right? Now, as far as if there are any remaining questions are concerned, you just can go through those again. And now we are going to meet day after tomorrow, and then we'll start further as well, right? Meanwhile, Go through the exam kit of the BPP, go through the exam kit of the Kaplan as well, reattempt, redo all the questions which we have done today and previously as well, right? So that you are prepared well at the end of the day. Okay, so yes, you want to have this Excel file you're asking of? Okay, okay, sure, no issues, no issues. I can straight away share it with you, and I will be uploading it right under the video. Okay, right under the video, right? It's gonna be shared to you. This will be uploaded maximum, by tomorrow morning. It will be there, right? Anything else you want to ask or add or anything? You guys can. Otherwise, we are done. Okay. So time to say bye. Remember, just go through what we have, we have done today, because this is really very important. The more you practice in the FR paper, the more you are going to have your concepts strong and all and everything. Okay. Just go through this. And the WhatsApp group is created as well. I'm available over there 24/7. So while sitting and reading, if you come across any problem or something, straight away send me the message, right? I'll be more than happy to assist you and guide you in that, right? Even if I have to reply you via text, via voice note or a video, I'll do that, right? And prepare well, because this time and this preparation time, it really counts over here. Done? So till we meet again, day after tomorrow, same time, same place, same channel. You have to take care of yourself. Oh yeah, one more thing. Today we started the class at 6:30 of your time, right? I'll check with the coordinator. I mean, obviously, beforehand, a message will be shared in the WhatsApp group. I'll see if, I have a meeting day after tomorrow in my office as well. Might be possible I'll be requiring some 15 extra minutes to start off as far as the class is concerned. But this will be shared beforehand, and I hope that if, I carry forward by 30 minutes, it's okay with you guys, right? Rather than starting at 6:30 of your time, if we started at 7 of your time, I hope it's fine, right? Okay. Yes, it's fine. Okay. Done. So take care of yourself, your family, friends, and the people around you. Have a lovely day tomorrow as well. And then day after tomorrow, we're gonna meet at the same time, same place, same channel. Till then, take care. Bye bye.